Hi, I'm Ken Kirschenbaum. Thanks for joining us. This is another one of our webinars where we hope we convey useful information to you, those in the alarm industry. So we have a distinguished presenter today, almost called him a guest, Bart Didden. So Bart wears a couple of hats. He's the owner of USA Central Station, which is a central station with I think maybe 2 or more central stations around the country. And he also serves as the executive claims manager for Security America, which is an insurance risk products group now, not risk management group or risk retention group. It's now a risk product group. At any rate, Security America, I think their basic policy is $1 million, and they have excess coverage with Lloyd's of London for up to $5 million, if I'm not mistaken. And yes, I do recommend them because principally Bart Didden's role as the claims manager. Often overlooked when you look for insurance is how are the claims going to be handled? That really happens to be the most important issue, especially once you get a claim. Premium comparison, okay. I'm not suggesting that you accept some crazy lowball or get attracted to some extremely high premium, but a premium is much less important than how are claims handled. Claims are handled at Security America by a knowledgeable claims manager, which is Bart. He understands that in the insurance industry, the alarm E&O package has a unique, I'm not sure if it's the only one like this, but what's special about the alarm industry is the carrier doesn't expect to have to pay out. Based on the contract that is supposed to be used by the alarm company, they're insured, and the customer is essentially waiving any rights to bring an action against the alarm company. That saves the insurance company lots of money on claims. An article's coming out on my forum in the next few days where a company is saying that they understand that one of the popular carriers, not Security America, is exiting the industry, and I'm not surprised. By the way, we name them in my email article. I'm not going to name them today. They're exiting, and I'm not surprised because I did work for them, and all they cared about was paying a claim. As soon as the claim came, let's settle it. How much? Let's pay them. Let's send them some money. Well, boom. That reflects on the alarm company's loss run and results in higher premiums ultimately. And so I'm not at all surprised that they've come to the position now of, you know what, this program maybe isn't worth pursuing. But I'm not sure that that's the case, but you'll see who they are in my article. Anyway, Bart is exposed to many different kinds of claims. As many claims as I've handled in my career, which are hundreds, Bart gets presented with far more than I've seen because he sees them from 50 different states, and he's very busy dealing with them. He's working on his law degree. As soon as he finishes his GED, he's gonna start on that. But he's very well skilled and experienced in handling these claims. So Bart's presentation today is understanding risk management in uncertain times, which we certainly are in right now. I finally got a haircut today. In case you're all wondering why I'm so handsome, it's the haircut today. Okay, Bart, I'm going to turn this over to you now, and thank you all for coming. And Bart, it's all yours.
Thank you, Ken. Always a pleasure being here with you. And I'd like to just start out by saying how this presentation, the idea of this presentation came together. Constantly in certain areas of the country, we're getting bombarded with requests to negotiate the central station agreements with the end users when it comes to property managers. And, Ken has written about it. I've blogged about it with Ken, and we've talked about it in these presentations. But considering that we have a center in St. Paul, Minnesota, Minneapolis and St. Paul have really gotten hit, and it made us really reconsider our willingness to amend Kenny's base contract, which we use on these accounts. So we're going to talk a little bit about the anatomy of the claim process so that everybody has a good understanding of that. And we're going to talk about defense costs versus insurance costs, how much E&O and GL, should you have. Then we're going to talk about the different types of immunity, that there are, qualified and sovereign, and what effect, the defund movement could have when it comes to claims and the number of claims and the management, and also the effect of time and expense on your companies if immunity gets redefined. And then we're going to just hop into a real estate GL policy because I want to spark your interest in maybe going to look at your own individual policy, whether it's your business G&L and E&O policy, or if it's just your homeowners or business real estate policy. So with that, let's move on here. So the anatomy of claims management. It all starts with the reporting from the alarm company of an incident or an occurrence. All the documentation is really essential. Contracts, system plans, service tickets, proposals, correspondence, as-built, the completion certificate, the disclaimer form that you issued. All of that documentation and more is everything that you could give the claims manager will help him understand exactly what's going on, because once I get all that information, or a good chunk of it, then comes in the claims process, where we take the date of loss. And you're like, oh, that's kind of simple. No, it's not simple. It's really the first thing that I do, because we got presented with a claim notice. It's not an official claim yet, last week, and it's troubling. It's a wrongful death suit. It's a fire suit. The issue is that the system was installed in 2002. In 2002, Security America wasn't even in business yet. So we did not issue a policy at the time of the occurrence, but the alarm company owner at the time, because he was in a dealer program. He was selling accounts out as he was bringing them in. And even though he had a requirement to indemnify the buyer, the date of loss wasn't until 2017. But we didn't start writing this company until around 2004, 2005. So the date of loss really was the line in the sand saying, at the time of the installation, which also was the design and everything else, we weren't the carrier. So the date of loss really is like the first item. And no matter who you're insured with, if you're presented with a claim, you'll save a lot of time and a lot of heartache, because you might turn it over and give it to the current, your current carrier, and it might have been a loss in the previous carrier's term, and your current carrier is going to take a week or two, considering all the claims that they have, and tell you, hey, this isn't mine, it's the guy before me, and then you're going to have to start the process all over again. So there's the span of coverage, the date that we get it, and Ken has time and time again talked about this numerous times. As soon as you have an inkling that there is a loss, you have to call your carrier and say, I don't have a claim, I'm just reporting that potentially there may be a claim coming in the future. We don't know, but I've had a customer that's telling me that they've had a loss. Now, what kind of loss? Significant, insignificant, a busted window. Why would you call your insurance company for a couple $100 plate glass window? First, you're going to tell the customer, hey, that's not us, that's you, and so on. But let's say it's something a little bit more. You broke a $20,000 antique. The installer was in the house with a ladder, swung it around, or his tool belt is on his hip, and he's a little wider than normal, swings, hits it. That is, the kind of thing that you call and you tell us about, so that we make a note. Because if like this case with the wrongful death happened in 2000, and the installation happened in 2002, the account got sold that same year, you know what it's going to be like to try and get documentation? That's nuts. So the closer, even though the installation was all the way out there, that loss happened in 17, and it's now the estate that's looking to sue the alarm installer, and he doesn't have any records from 2002, and the event was 3 years ago, almost 3 years ago. Before the statute of limitations gave out, of course, they started filing their case. But you can't inspect the scene. You can't send an adjuster to the house that's burnt down and gone by now. So we're really, our hands get tied. So there's the type of loss, documentation review, which is all the documentation that you sent, and then the coverage review. And when we get into the real estate policy near the end of this presentation, it starts out by describing what is a covered event. And I tell you flat out, you should take your alarm GL policy and start reading it. The first section comes up, what is a covered event? And then it also comes up with exclusions, and then it also comes up with definitions. And it's important to know what you're covered for and what you're not. Clearly, gross negligence and wanton acts on your side, will limit, depending on the circumstances, could limit the value of your insurance policy. You still get a defense, but if you're found grossly negligent or wanton, as such as in a fraud, a legal action, you have no coverage for fraud if you're adjudicated and guilty of fraud. Be prepared to spend a significant amount of time being interviewed by your insurance company, so that the claims manager can understand the depth and breadth of the issue. Even though our friend Ken is not admitted in all 50 states to practice law, there are times that even Security America has used him to supervise the local attorney that we engage to represent our insureds. If you're with someone other than Security America and you feel that you're not being listened to or you're being ignored, or if right away, like Ken said in the opening, some carriers, what can we settle for and get out? Those insurance companies are not your friend, because they are looking to, cut their losses as much as they can. They know that it's expensive going to trials, and I've even started, defenses, and I thought that the contract was okay. It was not a Kirschenbaum and Kirschenbaum industry standard contract, but I've defended on lesser contracts. I don't like it. It's not easy, but we had one claim that started out at 8 million, went down to 6, then it went to 3, and then it just kept going down. We kept fighting, and we're going to talk about the cost of defense versus the cost of insurance. That guy is really happy that he has insurance. He should be even happier that it was through Security America. So then the claims manager comes up with his determinations, and then defense counsel choices. So the cost of defenses versus the cost of insurance. You won't believe this, but experts, and there's even some experts in the industry, they charge more per hour than attorneys. I don't know how the attorney bar let this happen or how this ran away, but most experts cost 2 to 3 times more than a partner at a law firm. Absolutely insanity. The kind of money that these guys get. In the attorney world, they're really good at billing out time. That's how they make their money. It's partners, associates, paralegals, research. If you ever end up in a legal action where it's outside of the industry, let's just say it's matrimonial or just a business kind of thing, you should call Ken. And this is another great reason why you should be in his concierge program. You should call Ken and get from him a description of the management style that you should give to your attorney that's doing your local work, because it talks about that you won't pay for in-house attorney to attorney conferences, that there's only going to be one attorney assigned to your case. There's so many things that can just build up all those fees. And that's one of the jobs that I have when I start running these defenses through these attorneys. As I'm picking attorneys all around the country now, I take out the contract and I go through it with them to make sure that they understand what the contract is compared to what they think the law is, because the alarm industry has been very good at enforcing the contract in all 50 states. The next considerable fee is additionally insured. If you're issuing additionally insured certificates to building owners or other customers that you have a duty to indemnify and a duty to provide a defense, if your defense and their defense is not 100% in line, they may tell you that they don't want your attorney, and where you can get one attorney to cover both sides, but you have to also pay for their attorney, and your insurance company may give you heartaches about that. So here again, another pitfall of the cost, versus the cost of insurance, where the insurance is much, much cheaper. Arbitration costs, the firm that's in Ken's agreement is very reasonably priced, but outside of having that defined in an agreement, and this is why you should have update agreements and not agreements from 1990 or 2000. The arbitration costs, what do? They get a judge, from another, district, or a retired judge. Some of them just do only arbitrations now, and they get, $500, $600, $700 an hour, and it gets to be a lot. Court costs, and then of course, all of this is if you don't have insurance or you're underinsured, there's your time for how much you're going to be involved in getting through your issue. So how much insurance should you have? This is the question that's been haunting everybody forever. The answer is still the same. How much can you afford? The Security America policy is a $1 million, $2 million aggregate as a base, and you can go up to $5 million. There are policies that that we can bolt on to raise it up over $5 million, and that kind of leads to, do you need umbrella or do you need excess? Now here in the Central Station, we don't do umbrella because we don't have any vehicles, and we have a good workman's comp policy, and again, we don't have people out in the field turning screws and hanging equipment. So we choose excess rather than umbrella, and it's it only applies to my GL policy. It doesn't apply to any other policies, but it's less expensive than the umbrella. If you have an umbrella and you have drivers, and the umbrella is over your auto policy, and you have some that have marginal records, your umbrella costs could be quite extensive. Also, about how much deductible should you choose? That's really a business decision for you. There really isn't a big advantage to having $5,000 versus $1,000 in your underwriting rates, but it's something that you can ask for in your quotes, and you can evaluate, for yourself. So let's move into immunity, because with the whole defund the police movement, and they're talking about immunity and doing away with governmental or sovereign immunities. I think this is, and Ken and I were having a spirited discussion about this before we got started. I think any watering down of the governmental or sovereign immunity will increase our risk to get pulled into court actions. Even though the court action will be against the community and the police, if it's because there was rioting or looting and the police or the fire department couldn't respond, the plaintiff is under no obligation to keep the net, the amount of defendants limited only to the government or the police department or the police officer. And you may get called upon to come in and testify. You may have to go to depositions before trial. your records may go, get gone through. It's just time and expense, and that's where I believe, as an industry, we have we have an exposure. If this immunity is watered down or diluted or removed, that we're going to get caught up in the machine, and it's a concern for me. I think it should be a concern for everyone. So, here's some more about the differences between qualified immunity and sovereign. As you can see through this, it doesn't free the government of its exposure to losses and judgments, but what it clearly does, I think, is limits the amount of suits and prosecutions from plaintiffs. When there is communities like Minneapolis and St. Paul, where we had a number of buildings that burnt to the ground that the fire department couldn't get to. We do a considerable amount of monitoring there, and it's a concern for us. So where we were somewhat willing to negotiate contracts with property management companies to try and find a fair and middle ground to defend my company in the case of a loss, we've tightened up, and we're waiting to see what the outcome is going to be. But I think this is a real issue that we have to be cognizant of. So we talked about how it can indirectly, protect the alarm industry, and we also talked about how it could, also open us up to be, additional defendants in cases. I'll be interested to hear, I know there's a couple of attorneys out there today. I'm interested in, they may dismiss it out of hand, but they may also say, what, everything is a possibility. So this is a heading page from a property insurance policy. Commercial general liability coverage form. And you see it's copyrighted by the Insurance Services Office, and it has that CG number, which is the number of the form, 00010413. The Insurance Services Office, or ISO, is a company that is owned by the insurance carriers and is a back office operation for insurance carriers. And I would venture to say that if you took out all of your policies that you have for your house, your business property, your auto, all of them are copyrighted by ISO. They are the gold standard in forms, and besides the form that I'm referencing here, the 010413, they also author all the exclusions and endorsements. And that's something that I'm going to touch on here, because the policy language in a policy, it states one thing, and then there's, afterwards there is exclusions. And then it states something else, and then something it excluded in the base policy, like the 010413, that it excludes, it reinstates in another item, in another form. So if you look here, this is the way that most policies start out. Coverage A, bodily injury and property damage liability, and they say we will pay these sums. We agree, pay these sums that the injured becomes legally obligated to pay, and so on and so forth. And it starts going along, through the document. But then it adds, another in the form, causes of loss special form. And here, exclusions, okay? We will not pay for the loss or damage caused directly or indirectly by any of the following such loss or damage, excluded regardless of any other cause. Okay, so I put in, part F. And the reason why I put in part F is because if you go down to number 3, insurrection, rebellion, revolution, usurp power, or action taken by a government authority in hindering and defending against any of these. The president was using the word insurrection and rebellion. This has a direct effect on the exclusions. So even though you have the policy, they have an exclusion if in this policy for insurrection or rebellion. But then there is an endorsement for theft exclusion. And it says, we will not pay for loss or damage caused by or resulting from theft, but we will pay for loss or damage that occurs during the looting or at the time and place of a riot or civil commotion. So now we have, is it a civil commotion and a riot? Is it an insurrection and a rebellion? Okay, and where there was an exclusion before, here, they will pay for building damage caused by the breaking or in or exiting of burglars. This is the dilemma of policyholders and risk managers and claims managers on how do you line up the policy, the exclusions, and then the endorsements, for a reported loss. And that's where sometimes, if you have, a company, I remember I was insured by a company for the alarm, for the central station. And in the contract, the subscriber said that they would indemnify and hold us harmless. Well, the insurance company fought that for 2 years. And Sarge went out and spent $61,000 till finally the other insurance company gave in on the contract language after depositions of the subscriber and my company, and then they are like, okay, so they paid us they paid Security America the $61,000, and they paid our supervising attorney in the process as well. Interesting to note, I added this policy also has an endorsement that changes the policy to exclude loss due to virus or bacteria. Now, this particular property is a bar and a restaurant, and virus and bacteria, bars, restaurants, they sometimes unfortunately go hand in hand. But this is even before the latest pandemic. And I'm sure that there are endorsements that are already written by ISO or exclusions that talk about the pandemic. So at this point, we'll take any questions. I guess maybe Kenny's going to come back, maybe not. But I think I can see the questions here as well. I don't know, Ken, you have any comments about my fears and
Yeah, I want a couple of things. First, I want to, I'll start where you ended, actually. So you see that there are exclusions in the policy, and you may not have coverage. However, that doesn't mean that you're not going to get sued. And that doesn't mean that that you might not have your own type of exposure. Your contract is what you need to use to protect yourself. It's good to have insurance. Matter of fact, you need it. It's necessary to have insurance because, but you need to rely on your contract. Your carrier is relying on your contract. So keep that in mind when you go ahead and contract with your customers and your insurance company. I'm distracted because I'm messing up my screen here completely and getting disoriented myself. Keep in mind that your carrier has its interests as well as yours. You have your interests, and your interests need to be protected primarily by you, and you need to make sure that your contract with your customers, your subscribers, are as strong as they can be. And that's something that's very essential. I want to comment about what carrier you might send a claim to. I caught Bart's statement. I'm not sure I heard it right, but I'll tell you which carrier you should be sending your claims to. It's not that if you install a system in 2004, it's not the carrier that is around in 2004 if there's a burglary in 2010. And now it's 2019 or 2020. It's the carrier on the date of loss. The date of loss is when your customer suffers their loss. So you could have a system that was installed negligently in 2015, but the loss doesn't occur until 2018. It's now 2020, and the lawsuit starts. So you look back at the claim and you see that the lawsuit is from a loss in 2018, and you look and see who your carrier is in 2018, and that's who you send it to. And the reason for that is because these policies are written as occurrence policies. So it's the occurrence date, and the occurrence is the date that the claim becomes alive. And a claim, in order to have a claim, you have to have not only some negligence or a breach sitting out there, you have to have damages. And so it's the loss itself that triggers the claim date, and that's the occurrence date. The other kind of policy is a claims made policy, which the E&O carriers do not use. A claims made policy, by the way, is something that lawyers have, for example. And then it's the date that the claim is made. It doesn't matter when the negligence was done. So that's that issue.
well, in the case that I was talking about, the plaintiff's allegations are allegations of the installation and not of the inaction of the system some 14, 15 years later.
Okay.
I know, and the buyer of the account has an agreement with the seller that the seller is going to indemnify the buyer. And now, this is something that you and I have talked about in the past. I mean, how long do you indemnify the buyer? Do you indemnify the buyer for 15 years? Seems a little extraneous. And also
well, the indemnity will last as long as the contract does.
The installer isn't in business anymore and doesn't have any kind of coverage or business entity. at the time of the occurrence of the loss.
Well, yes, that's a problem. Of course, if the alarm company's not in business anymore, they're not going to be concerned with a claim that's brought against them. That's the issue there, I think, right? Why would they be concerned about a claim if they're out of business? We have that. Companies sell their assets, for example, and they get paid and they dissolve and they're gone. So the issue is, should a seller retain its insurance coverage?
Well,
the answer is should for a period of time.
Well, they're only gone if they follow your advice and Mitch Reitman's about a corporate structure and being an S corp or that type of, that you can insulate yourself personally, but for people that are operating as partnerships or DBAs, you're never out from underneath the liability.
Well, I can't even contain myself from describing those people. If you are, no one on this webinar is operating in their own name or as a partnership. No, they're not. They had the brains to sign on to this webinar. They certainly had the brains to create an entity to conduct their business. Okay, so we're not talking to those people at the moment, right? Let me say this to you about those that are concerned about risk. Being in the alarm industry is very much in this way like owning a dog, and you get the question, has this dog bitten anybody? The only correct answer to has this dog bitten anybody is not yet. No, never has, never will. No, not yet. And if you're in the alarm business, have you been sued? Well, let's start with an early one. Have any of your customers suffered a loss? Could you really say no, never? Best answer is not yet, if that's the best you could have. And have you ever been sued? Not yet. Okay, you will be. I've told this story many times. When I first started practicing really in this industry, some guy was selling his company. I represented him, and he had no insurance and never had a claim, never had a loss. He'd taken over, I think, his grandfather's business. His company had been in business for a very, very long time, and he got sued right before we closed. His technician jumped out a sliding back door rather than activated, and that's where they came through, and that's what he was sued for. Wasn't a huge claim, but it was enough to aggravate the hell out of him. I'll tell you that. He had to defend it. I don't even remember what happened, but you're likely to get sued at least once in your career history as an alarm company, and you need to insulate yourself from that lawsuit as best you can, and you do that by having a corporate entity. You do that by having up-to-date contracts. You do that by adopting best practices in how you do your installations and conduct your business, and you do that by selecting the right central station that you have confidence in, and you do that by having insurance that you know is going to be there to protect you if there's a claim brought against you. And those are the reasonable steps that you need to take when dealing with risk management, which is what we've been talking about for the last 45 minutes. Bart, I can't tell whether anyone has any questions because
I don't see any in the chat.
Okay, I messed up my. Oh, here we go. We have loads of questions. Let's see. Oh, this is telling me how I can get my screen back. Where is Ken's picture? My picture isn't here. Yeah, I must have lost it. I don't know. Oh, am I up
There you
now?
go. Yep.
Who is that?
So that's our
Oh,
contact.
I thought there was I saw that female as soon as I clicked my picture, and I go, what? Okay. Uh, what happened to Cal Union and Luke's Brock? Wow. I'll tell you about Cal Union. I'm practicing law a year and a half. It's nighttime. I'm in my office, and I get a phone call, and it's, what the heck is his name? Richard something or other, calling me from California, and he's calling me from Cal Union. And would I be willing to handle a defense case for Cal Union for the alarm industry? And it was one of the counterclaims on one of the collection cases that I had brought. So I was first surprised, but then I said, yeah, sure, I'd love to handle it. And I did. I wound up, by the way, handling all of Cal Union's work here in New York, as well as consulting for them elsewhere. And of course, with my luck, Cal Union stopped writing the alarm industry. At one time, it was the only show in town, I believe.
Yeah, they wrote a lot.
Right. They at that point, as far as I knew, they were the only show in town. And if you wanted Cal Union insurance, you had to go through Luke Brock. I haven't heard from Luke Brock in decades. I'm going to say I think he's still around, believe it or not. I know he's older than I am, and I'm older than Bart, and you can see what he looks like. So I don't know what Luke Brock is doing these days. But Luke Brock made me remove the indemnification clause from the alarm contract in the mid 80s, Bart. And that clause was removed for about 5 years. And his thinking was that he said that there had been a case in California where the court threw out the alarm contract because of the indemnity clause, because the court's reasoning was it blocked the customer from suing the alarm company, and it blocked the was it the indemnity clause? Yes, it was the indemnity clause, and it also screwed up their insurance somehow. At any rate, I wound up putting it back. I wound up putting the clause back. You know what? Now that I'm thinking of it, it might have been the waiver of subrogation clause that we had that he made me take out. But either way, both of those clauses, the indemnity and the waiver of subrogation, are essential in the contract. Waiver of subrogation, by the way, even more important than the indemnity clause, in my opinion. I very often let the indemnity clause go. Anyway, California Union stopped writing in the alarm industry, I was told by them, because they found that it wasn't lucrative enough for them. It was a small potato type of underwriting, and they went into municipal liability instead. So here's another question. Some management firms want to name as a certificate holder or additional insured all their related LLCs. That could be 20 plus firms. What is your comment on that? Well, my alarm company shouldn't be naming any customers as additional insureds. I don't know what Bart's position is. What is it, Bart?
Well, we agree with your position that, they should not be. The only fallback that we will, consider is when we issue such a certificate, we add language into the certificate that the additionally insured status is only in effect when your employees are on the site performing their job. So if you have an employee that drops something off the ladder and hits somebody in the head, okay, you're going to end up, paying or doing something on that loss, and you're gonna end up protecting the property owner as well. But the big exposure is in the monitoring and the municipal response. So when you issue an open-ended additionally insured status certificate, you can get dragged into every suit, whether you're in it or not, because the property owner is now a name insured on the policy.
You don't want to name your customers as additional insureds if you don't have to. I understand sometimes you do. You have to check with your carrier to make sure that it doesn't mind naming them. Naming them as additional insured raises questions because you're now providing your insurance coverage for them, yet your contract is going to say that you have no liability. So the real problem is, if you're not getting your contract signed and you're providing indemnification, because that's what the customer contract calls for, and you are signing it, then the answer is you better have them named as an additional insured to protect yourself. If you're going to be giving indemnity to your customer, you better make sure that you carry coverage, insurance coverage, so that you have indemnity for the indemnity you're giving your customer. What are your comments with management firms that stated in their agreement or future engineers, contractors, etc., as a requirement? Oh, that would be as an additional insured. Again, I'm not in favor of adding additional insureds, and I would resist that. And I also no indemnity. If you're giving indemnity to all those people, then yes, name them as additional insureds. Is there more risk for a PERS system than a traditional burglar alarm system? And does the insurance carrier rate based on this? Bart, I think the answer is yes, but Bart, do you want to comment on that?
No, the answer is yes. Every time you install a burglar or fire alarm system, the actuarial table says that the chances of those locations being broken into on an average of a large pool is small. But most people that I know that have PERS systems are people with underlying issues, and the average, I think now the average length of a PERS system is about 3 years. I know it used to be like 2.5. So that everyone at 3 years, hopefully before they expire, if they have an accident, that they push the button and you did it. Because if they didn't get to push the button and they had an accident, their chances are strong that there's going to be a claim from the estate and the account. The wrongful death that I was talking about, in a fire during the presentation, is actually an action from the estate.
Right. Well, the issue is that when you're writing PERS contracts, the claim that's likely to come is personal injury or wrongful death, and those tend to be very expensive types of claims, not only to defend, but to have to resolve. And there are some states where, man, it is just a disaster to be involved in one of those kind of cases. The one I know for sure is Alabama, but there's another 6 besides Alabama that if you're writing PERS in those states, you need to be you better have a great contract, and you better have insurance behind you. The next question is,
well, the one good thing I'll add on about PERS is that all of these retailers / dealers are very good about no contract, no equipment, no service. A lot of these guys, they're sold over the phone. I've fallen and can't get up TV commercials and things like that. No contract, no equipment, no sale. They're much better at compliance to that rule than alarm companies are.
What if we presented the K&K contract to the carrier, but we are forced to sign a GC contract for the install and a claim occurs? Can an insurance carrier deny coverage since the submitted contract was not used? You need to make sure that your policy does not require you to use the approved contract in order to have coverage for a particular claim. If your policy reads that as a condition precedent to coverage for a claim, you would have to produce an approved contract, and you don't, well, guess what? You don't have coverage. I am not aware of any carriers that require an approved contract to be presented before it will undertake the handling of a claim. They all want you to be using proper contracts. They all hope you do use proper contracts, and they will all drop you if they find out you don't. So that is really what's going to happen. If you've got that one claim comes in, you don't have a proper contract signed, the one that they looked at, they'll handle the claim, but that'll be the end of your coverage. Bart?
You know, two things. One, there was a company, I don't know if they're still offering it, but there was a company offering GL insurance with an E&O that was had a contract warranty provision in the policy. So and they had very attractive rates, but the issue was if you had a claim and you didn't come up with the contract for that customer, you had no coverage. So you have to be cognizant of that type of a program. And the other thing is that, you know, we've had this discussion numerous times at Security America because they would send in a new K&K contract with an application. And I was like, well, the company's been in business for 30 years. What if the first 10 years or 20 years or up until last year are all on toilet paper? And when you fill out the application for insurance and they ask you how many accounts do you have under contract, they're looking for your affirmative statement that if you say 90% or 100%, that, you know, that's, you know, based on the contract that you presented. And if you are grossly under that and it's a big enough claim, you may just get an out and out, you know, denial and based on a fraudulent application to an insurance company.
Right, you wind up losing your policy at that point. Here's a question: does the K&K contract state that the alarm company has to be named as an additional insured? The answer is yes. And by the way, a customer that fails to name you as an additional insured has breached the contract, and it's a non-curable breach.
You know, Kenny, I'll add to that, you know, in the insurance forms I went through, I did find a section that said that additionally insured status is provided by the policy when required by a contract. Right. So even though the end user here in the alarm industry scenario has a obligation to name the alarm company as an additionally insured, and they didn't, and I've had claims like this that I've you know, managed for the company, and the first thing I do after I see I have, you know, it's always a great day when I have a Ken Kirschenbaum contract, and I call the plaintiff's attorney or the insurance company a subrogation action. I said, okay, will you please supply me with the additionally insured status as required by the contract? And they're like, what are you talking about? I said, well, it's number 14 on this form. And, you know, and they're like, oh, well, we never heard of such a thing being required by an alarm company. I said, well, it's there. And as in the real estate form that I was quoting from, and most, all insurance policies, if the subscriber binds themselves to an agreement and a contract that they have to provide it, the alarm company, the insurer is on the hook to do it. So, am I a stickler for asking for certificates from everybody? No, but it's an arrow in the quill when it comes to defending suits. And Ken, the suit that you and I still have running now for, I think it's about 4 years, where there was a fire loss. You and I had the subrogation attorney completely talked out of even including the alarm company until there was 2 other defendants, and the subrogation attorney's like, hey, I'm sorry, but I got to include you because, it would look funny if I didn't. But, when he was presented with the additionally insured requirement, they folded in that first week.
Okay. In the AIA agreement, your agreement is non-existent, and if you do new building work, it is a requirement. So what do you say on that? Well, if you're signing an AIA agreement, it's probably in connection with an install. I will say this to you: I do advise alarm companies all the time. If it's only the install, go ahead and sign the vendor agreement if you have to. The GC's agreement, which is going to be an AIA, an owner's agreement, it's going to be an AIA, or it's going to be something that they've copied from AIA. That's the American Institute of Architects. And that contract, of course, reads completely opposite to what the alarm contract reads. But if it's only for the install and you got to have that job, I give my blessing if that's what you're looking for. But not any after install services.
Right. So, and in a claim, I'd be looking for the signed completion certificate. I'd be looking for the 100% performance test when the system was turned over and the completion certificate was signed. And I'd be looking for the disclaimer agreement for anything that you disclaimed that, maybe, something that you feel is short of the code and the AHJ approved anyway, any deviations. But I agree with Ken. I would sign the AIA agreement too, but only for the install.
What is your opinion on firms and their requirements, such as Compliance Depot? What's your opinion about Compliance Depot? I think I should know about that, but I don't. Compliance Depot, Bart, do you know what they do?
Oh yeah, you and I should have created that company.
Yeah.
So what they do is they take over all the back office risk management functions for anybody, property owners, real estate companies, and you give them a list of all of your vendors, and they go out and they, for a fee, I think even the vendor has to pay Compliance Depot a fee, but they have to send all of their certificates of insurance and AIs and everything is maintained, recorded, tracked, and the renewals each year are tracked by Compliance Depot for all these property owners, and they really are hard, because we had a problem with them when the risk retention group was a B++ rated company, and they wouldn't lower their recommendation to the property owner to say B++ is good enough. And they said it had to be only A-rated paper. And it took us a long time, but then we found out as long as the property owner tells Compliance Depot in a written form, I'm willing to accept my alarm company in a B++, will they get off the alarm company's back? But that's all become mute since now everything we write is in the A-rated paper from, issued by Lloyd's.
We see, I guess we see a lot of that also with real estate management companies that are out there that are managing properties all over the country. They've started to standardize their vendor forms so that they want the same form signed by the cleaning service, the carpenters, the plumbers, the electricians, and the alarm companies. And we have to fight over those contracts all the time. That's one of the advantages, by the way, of the concierge program, where you get a free half hour each month towards contract negotiations. So if you do entertain changes in contracts or signing your customers' contracts, you should sign up for the concierge program. It's worth it. Last question. You mentioned under contract. After the named period, meaning the term of the contract, has expired, are they still considered under contract? Well, your contract is going to survive for as long as you are providing your services, and it's going to survive any obligation that you're claimed to owe your customer. So if your customer is coming after you for something under that contract, that means that contract is still going to govern the relationship. The contract doesn't just expire on the term date, and then you're exposed. It'll always protect you after that. Okay, not if you go back after the contract's expired, because then you don't have any contract. So your contract's expired. You get a service call. You point out to the customer, well, you stopped paying your monthly when your contract expired. They go, okay, no problem, we'll pay you, just come out to do the service call. So you come out and do the service call, you get your $150. A week later, there's a loss. And now they sue you. And you pull out your contract. Well, that contract is not why you went out. You went out because you got a phone call for a per call service that you have no contract for. You don't have your contractual protection. You got a problem. You might have insurance coverage, but you don't have a contract to rely on.
Well, that's always why you and I have been telling people that on service tickets that there's the, you don't have the long form, but you have a statement about the limitations on the service ticket.
Well, that falls under something's better than nothing. But a service ticket is a service slip or a completion certificate is not a substitute for a service contract. So be very careful about that. You need the all-in-one forms. That's what you should be using. And that's a good way to end this webinar. How's that, Bart? We're over time now. Everyone stuck it out with us. I want to thank all of you for sticking out with us. Sorry, I messed up my thing up here and had to figure out how to get it back, but I finally did. So I want to thank Bart for the presentation, a great presentation. I want to thank those of you who attended. I hope you learned something. If any of you have any questions, contact Bart. He's easy to get a hold of. USA Central Station. You can find him on the Alarm Exchange. He'll be happy to talk to you about his Central Station or about Security America or about why you need K&K contracts. All three important issues, right, Bart?
And not necessarily in that order. First the contract, then the Central Station, and then the insurance.
Okay. Thanks, everybody. We're signing off now. Bye-bye.
Thank you.